There's a specific income number that quietly governs the math of middle-class financial planning in the United States, and almost nobody talks about it directly. The number is $70,000. Per the U.S. Census Bureau's most recent report, released in September 2025, the median post-tax household income in the United States was $72,330 in 2024, up from $71,040 in 2023. In other words, the typical American household takes home about $70,000 a year after federal and state taxes. That number is the actual money that flows through bank accounts, pays mortgages, buys groceries, and either accumulates as wealth or evaporates into lifestyle. It's also the income level that most retirees aim to replicate in retirement, because replacing your working life take-home is the cleanest benchmark for whether retirement will feel like a step down. So $70,000 isn't just a random salary figure. It's a structural anchor in the math of American middle-class financial life. This video walks through 7 specific rules that operate around the $70,000 threshold, and how each one changes the decisions you should be making depending on which side of the line you're on. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. The reason I'm framing this video around $70,000 specifically, rather than $50,000 or $100,000, is that the math behaves differently at this level. Below $70,000 of post-tax income, most households are mostly making it work, with limited margin for wealth building. Above $70,000, meaningful surplus starts becoming possible, and the decisions about what to do with that surplus determine almost everything about long-term financial outcomes. The line isn't a magic number. It's where the math actually flips for typical American households. Rule 1. $70,000 is the realistic retirement income target for most middle-class households. The first rule is about retirement planning, which is where the $70,000 number shows up most cleanly. Conventional retirement planning advice says to target replacing 70 to 80% of your pre-retirement income, on the theory that some expenses go down in retirement, like commuting and work clothes, while others go up, like healthcare. For a household earning the US median of $83,730 a year, which is the most recent Census Bureau figure for 2024, 80% replacement is roughly $67,000. A household earning slightly above median at $90,000 a year hits a target of $72,000 with the same multiplier. At $100,000 of household income, the target is $80,000. So $70,000 a year of retirement income, roughly, is the practical target for households earning between about $85,000 and $95,000 a year, which covers a meaningful chunk of middle-income US households. The action item from this rule is to actually compute your own replacement target. Take your gross household income, multiply by 0.80, and that's the inflation-adjusted retirement income you should be targeting. Don't accept the generic "you'll need $1 million" framing. The right number for you depends on your specific pre-retirement income, and it's almost always smaller than the YouTube content suggests once you account for how much your current income is already going to taxes, retirement savings, and the mortgage you'll have paid off by then. Rule 2. The portfolio target for $70,000 of retirement income is much smaller than $1.75 million. The second rule corrects one of the most common math errors in retirement content. The naive calculation, using the 4% rule, says that $70,000 of retirement income requires a portfolio of $1,750,000, because $70,000 divided by 0.04 equals $1,750,000. That number sounds intimidating, and it makes early retirement look almost impossible for normal earners. But that calculation ignores Social Security entirely. The math changes dramatically when you account for it. Per the Social Security Administration's March 2026 monthly snapshot, the average retired worker benefit is about $2,080 a month, or roughly $25,000 a year. For a household with two earners who both qualify for Social Security at full retirement age, that's about $50,000 a year of inflation-adjusted income that arrives automatically, with no portfolio required. To hit a $70,000 total retirement income target with two full Social Security streams at the average level, the household only needs the portfolio to generate the remaining $20,000 a year. At a 4% withdrawal rate, that's a portfolio of $500,000, not $1,750,000, a factor of 3.5 difference. For a single earner household with one Social Security stream of $25,000, the remaining gap to $70,000 is $45,000, which at 4% requires a portfolio of $1,125,000. Still a lot of money, but materially less than the $1,750,000 figure that the naive math produces. The action is to actually calculate your expected Social Security benefit at full retirement age, which you can do for free at ssa.gov by creating an account, and then compute your real portfolio target. Almost everyone who runs this calculation honestly finds that their target is meaningfully lower than the YouTube content suggests. There's a secondary insight worth mentioning. Social Security benefits scale meaningfully with claiming age. Claiming at age 62, the earliest possible age, locks in benefits that are about 30% lower than the full retirement age benefit at 67. Delaying all the way to age 70, the latest possible age, increases benefits by 24% above the full retirement age benefit. For a household where the full retirement age benefit would be $2,080 a month, the difference between claiming at 62 and claiming at 70 is roughly $950 a month, or $11,400 a year, for life, inflation adjusted. That delta has the same retirement funding impact as having an additional $285,000 in the portfolio at a 4% withdrawal rate. The claiming decision is one of the highest leverage retirement decisions available to most households, and it costs nothing to optimize beyond a few hours of careful thought. Rule 3. Below $70,000 post-tax, prioritize income growth over investment optimization. The third rule is about where to focus your financial energy at different stages. Below $70,000 of post-tax household income, the math on wealth building is hard. After taxes, housing, transportation, food, and basic obligations, the savings capacity for most households at this level is somewhere between $200 and $800 a month. At that savings rate, the variable that matters most isn't your asset allocation or your tax optimization strategy. It's the income number itself. Going from $60,000 to $80,000 of household income, which is achievable through promotion, job change, or a second earner, produces vastly more long-term wealth than any investment-side optimization could. For someone earning at the lower end of the US distribution, the highest leverage move is almost always to increase income. Per Bureau of Labor Statistics data on wage growth among job changers, employees who switch jobs see wage premiums of 5 to 10% above those who stay. 2 job changes over 5 years at 7% each compounds to a 15% base salary increase, which on a $55,000 starting income is roughly $8,000 a year of additional income. Reinvested in retirement accounts and grown for 25 years at 7% real return, that single career decision becomes about $200,000 of additional wealth by retirement. No amount of expense tracking or expense ratio optimization on a smaller savings rate can produce a number that big. The same logic applies to building skills that command higher pay. Certifications, advanced degrees in fields where the credential actually moves wages, side businesses that gradually replace W-2 income. All of these are higher leverage than rebalancing a $20,000 portfolio between asset classes. The personal finance community sometimes gets distracted by optimization games that don't actually move outcomes for households at this income level. A 50 basis point expense ratio reduction on a $20,000 portfolio saves about $100 a year. A career move that adds $5,000 a year to base salary, sustained over a working life, produces 100 times that amount. The math is clear about where to focus. Rule 4. Above $70,000 post-tax, the savings rate decision starts dominating. The fourth rule kicks in above the $70,000 line. Once your post-tax household income is above this threshold, the math shifts. You now have meaningful surplus capacity, somewhere between $1,000 and $3,000 a month, depending on your specific situation. At that level, the decisions about what to do with the surplus, how much goes to savings versus lifestyle, start dominating long-term outcomes more than further income growth does. The math here is concrete. A household earning $90,000 of gross income with $70,000 post-tax, that saves 10% of gross is putting away $9,000 a year. The same household saving 20% is putting away $18,000 a year. Over 25 years at 7% real return, the 10% saver ends with about $568,000. The 20% saver ends with about $1,137,000. Double the savings rate, double the outcome. That difference is much bigger than what one more job change or one more raise would produce for the same household. Above the $70,000 line, the income engine is already running well enough. The question is, what fraction of the engine's output is being routed to wealth versus consumed? Rule 5. 70K post-tax doesn't mean 70K spending capacity. The fifth rule is the one that catches most middle-class households off guard. Having $70,000 of post-tax income doesn't mean you have $70,000 to spend on discretionary lifestyle. After fixed costs, the actual discretionary spending capacity for a typical $70,000 post-tax household runs somewhere between $25,000 and $35,000 a year. The math breaks down roughly like this. Housing for a middle-class household typically runs 25 to 30% of gross income, which is $21,000 to $25,000 on an $84,000 gross. Transportation runs about 15% of gross, or $13,000 a year, including car payment, fuel, insurance, and maintenance. Food, including groceries and modest restaurant spending, runs about 12%, or $10,000 a year. Insurance premiums beyond what's in the car number, including health insurance and any life or disability coverage, runs another $4,000 to $8,000, depending on employer subsidization. Add up the fixed costs, and you're already at $48,000 to $56,000 a year before any discretionary spending, vacations, savings, or unexpected expenses. The $70,000 of post-tax income isn't the spending budget. The leftover after fixed costs is the actual budget, and that's where the wealth building either happens or doesn't. The pattern that catches most middle-income households is that the leftover after fixed costs feels small relative to the headline income number. Someone earning $84,000 gross thinks of themselves as an $84,000 household. The actual discretionary capacity is closer to $20,000 a year, or $1,700 a month. That's the entire engine for vacation, hobbies, gifts, restaurant meals beyond the basics, and any wealth building above what the 401k deduction already captures. The reason households with seemingly comfortable incomes feel financially stressed is that the gap between the income headline and the actual surplus is much larger than the gross number suggests. Understanding this gap is the first step toward making realistic financial plans instead of plans built on illusions about how much money is actually available each month. Rule 6. The first $70,000 of retirement savings is structurally different from the rest. The sixth rule is about how wealth accumulates through specific dollar thresholds. The first $70,000 in retirement accounts is the slowest. At a 7% real return, $70,000 generates about $4,900 a year of growth, which is meaningful but not transformative. The second $70,000 to bring the balance to $140,000 generates an additional $4,900 a year of growth, but it comes with all the compounding from the first $70,000 already in play. So the total growth at $140,000 is closer to $9,800 a year. By the time the balance reaches $700,000, 10 times the original threshold, the annual growth is about $49,000, which approaches the level of a full-time job's salary. The implication is that the first $70,000 is the hardest psychologically, because the visible growth feels slow. The temptation to give up on the saving strategy is highest at the lowest balance, when the rewards are smallest. The correct response is to recognize that crossing the first $70,000 is structurally the hardest step, and that everything after it gets meaningfully easier. The same monthly contribution that took 7 years to build the first $70,000 will build the next $70,000 in about 5 years, and the third $70,000 in about 4 years, because the compounding is doing more of the work each time. Charlie Munger captured a related dynamic in a quote that's well known in the personal finance world, though he used a slightly higher threshold of $100,000. He said the first $100,000 is the most painful to accumulate, and that getting your hands on that first chunk of capital is the difference between meaningful long-term wealth and never quite getting there. The mechanism he was describing is exactly the compounding dynamic above. At small balances, your contributions do almost all the work. At larger balances, compounding does more work than you do. The transition between those two phases is what makes the journey from $0 to $70,000 feel so different from the journey from $70,000 to $140,000, even though the dollar amount is the same. The action item is to recognize where you are on this curve and not get discouraged by how slowly the early phase moves. The slow phase is structural, not a sign that the strategy isn't working. Rule 7. $70,000 in liquid emergency cushion is too much for most households. The seventh rule is a corrective to a common oversaving pattern. There's a tendency in the personal finance community to recommend ever larger emergency funds, sometimes up to 12 months of expenses, on the theory that more cushion is always safer. The math doesn't actually support that recommendation for most households. An emergency fund of $70,000 in liquid cash for a household with about $5,000 a month in fixed expenses represents 14 months of cushion. That's well beyond what financial planning research actually justifies. The standard benchmark, 3 to 6 months of expenses, is supported by Federal Reserve research on the typical duration of unemployment and household income disruption. For a $5,000 a month household, that's $15,000 to $30,000 of liquid cash. The reason additional cushion beyond that is suboptimal is opportunity cost. Cash in a 4% high-yield savings account against 3% inflation produces only 1% real return. The same money in a broad market index fund averages 7% real over long horizons. The 6% annual difference on the $40,000 of excess cushion between $30,000 and $70,000 is $2,400 a year of foregone wealth building. Over 20 years, that compounds to roughly $98,000 of lost wealth from oversaving in cash. The right emergency cushion is the smallest number that lets you actually function, not the largest number you can accumulate. How to use the 7 rules together. The rules cluster around the $70,000 line because that number sits at a meaningful structural inflection point for US middle-class households. Below the line, the dominant lever is income growth. Above the line, the dominant lever is savings rate decisions. At the line, the rules about replacement income, emergency cushion sizing, and portfolio targets all interact in ways that determine whether retirement will feel like a step down or like an extension of current life. My friend Pete, a 51-year-old high school teacher in Pennsylvania, I've described on this channel before, is a useful example of how this works. His current household income is about $85,000 a year, which puts his post-tax around $69,000. His target retirement income is roughly $70,000, partly because that's what his current life costs, and partly because his work expenses and tax burden drop in retirement, mostly canceling out any decreased income need. With his expected Social Security benefit of about $2,400 a month at age 67, plus a spousal benefit for his wife of about $1,200 a month, the household will receive about $43,000 of automatic retirement income. The portfolio gap to $70,000 is $27,000 a year, which at a 4% withdrawal rate is a target of about $675,000. He has $185,000 saved at 51, with 16 years to go before full retirement age, and with consistent contributions of about $600 a month and standard 7% real returns, his portfolio is on track to hit roughly $747,000 by 67. That puts him comfortably above his target, with about $75,000 of cushion built in for sequence of returns risk or unexpected expenses early in retirement. The math worked for Pete because he understood that his target wasn't $1.75 million. His target was $675,000, which is a meaningfully different planning problem. The Social Security stream did most of the work. His portfolio just needed to cover the gap. That's the version of retirement planning that actually applies to most middle-class American households, and the $70,000 anchor is the cleanest way to see it clearly. Drop a comment with your current household income relative to the $70,000 post-tax line, or which of the 7 rules feels most relevant to your situation. I read every comment, and I'll reply to as many as I can. And if you want me to walk through the specific Social Security claiming strategy that maximizes your retirement income, including the math on claiming at 62 versus 67 versus 70, hit subscribe, because that's the next video. I'll see you in the next one.